Let's touch base with the management of DCB Bank. Strong Q4, healthy profits, stable NPAs and growth strategy and outlook for FY19 is what we are trying to assess from them. Murali Natarajan, who's Managing Director and CEO of DCB Bank, joins in to share more details. Mr. Natarajan, great to have you on the show. Great performance this quarter round. Profit growth 22%, loan growth nearly 30%. Are these numbers sustainable?
So it's not just about the quarter. As you know, from October 15, we have been rapidly expanding our branch network. When we announced 150 branches to be added in 2 years, there was a lot of excitement. We were confident that we will be able to execute the plans well. So we have expanded to 318 branches by end of the fourth quarter. That is number one. We have not changed any of our strategy with respect to business. If you look at our product distribution, 40% of our book is in mortgages, 12% is in SME, MSME, 18% is in agri-inclusive banking, 6% is in commercial vehicle, and corporate banking in the true sense is only just 17%. We are a true or pure, I would say, SME, MSME segment focused company. So if I look at each of the business, the performance has been pretty good as compared to the previous year. We have kept our NPAs in control. In fact, we had a little bit of improvement in our gross and net NPA in the fourth quarter based on the strong recoveries and upgrades that we had on the fourth quarter. We have maintained our NIMs at a very stable level, although there has been huge amount of competition. And the branch rollout hasn't really our cost income ratios are in the similar range to what it was when we started the journey of this big branch expansion. So those are the factors I would like to credit for the improvement in performance.
If you look at the full year performance as well, profits have grown 23% versus 3% in FY17. Can we see profits growth at 20-23% for this year as well?
I don't comment on profit growth. What I can comment on is that if you look at our balance sheet, if you look at our loan book 3 years ago, we were half the size almost as we are today. That means we doubled our book in about almost doubled rather in about 3 years time. The way we are building our franchise, we believe that if we continue to do a good job, we should be able to double the book in 3 to 3.5 years time, without changing the mix of the product. In fact, the mix would probably skew more towards smaller ticket than corporate banking. And if we continue to improve our efficiency, productivity and do not damage the NPA, I do expect better performance in all metrics.
Okay. What about the loan growth then? Because that's improved to a good 29% as opposed to 22% the last year. Can we say that now the DNA of DCB is set to achieve 20 to 25% growth over the next 2 to 3 years?
So our intention, based on all the investment that we have done so far, is to try and achieve double the loan book in 3 to 3.5 years. And our intention is also not to change the mix. In fact, I would say that the mix might change more towards doing smaller tickets in the self-employed segment. Our target market is self-employed. We have very limited salaried segment in our book, both on deposits and loan side. So I would say that we are unlikely to change the product mix. We'll maintain similar product mix and we'll aim to achieve double the book in 3 to 3.5 years.
Right. Although margins have been holding well at about 4.16% for FY18 versus about 4.04 in FY17, do you see them sustaining over this 4% level, given the kind of high competition that you've got to deal with in the sector? And how much do you see your cost of funds as well as yields rise?
So the margins at 4%, we have done better than what we expected. The competition, like you stated, is very keen in all segments of the book, especially in the in the segment that we operate, which is self-employed. We get competition from NBFCs, banks, smaller, bigger, the new players, everyone. I think what we have been able to achieve is, if you look at our CASA, our savings growth has been 27% and overall CASA growth has been 25%. That has helped us to kind of maintain margin. if we keep a very tight control on the NPAs, then also the margins remain. I would say the long-term business model that we have thought about is that as long as our margins are 375 basis points or slightly above than that, we are good. But I do expect margin compression in the coming quarters.
Q4 GNPA ratios improved slightly to 1.8% with Q4 slippages lower and upgrades recovery holding well. Do you see GNPA sustain at below 1.8 for FY19, especially when we are seeing small business like SMEs strained post GST?
The business model that we operate, we believe that as long as we can keep our gross NPA below 2% and net NPA below 1%, we are following our business model. We are targeting a self-employed segment, which is considered to be slightly more risky than salaried segment. However, I would like to say that we do secured lending. Bulk of our lending is secured. Therefore, even if we do have some kind of slippage, our recoveries over time becomes better. Therefore, we are able to kind of control the net NPA. Having said that, we have to be very watchful. Fortunately, the corporate lending book is only about 17% for us, and we don't intend to kind of grow that aggressively. So when you have big ticket kind of NPAs, it is very hard to recover quickly. So since our corporate lending is limited and we are doing secured lending and targeting very carefully, I expect that our gross NPA to be below 2% and net NPA to be below 1%.
Right. You raised about 380 crores in 2017. How long will the current capital last to support growth?
The kind of investment that we have made, we are confident about our organic growth capabilities. So at the moment, our focus would be on organic growth. Regarding capital, our capital adequacy is above 16%. And even if we do grow at 20-25%, I do believe that it should be sufficient to take us through for anywhere between 12 to 18 months. When we come to that point, we will consider capital raising.
Okay. And lastly then, what is it that you're expecting in terms of a cost to income ratio? Because that still remains relatively high versus about your peers, which are currently quoting and ruling at 59% mark. How is it that you see or plan to improve your operating efficiencies, and where do you see your cost to income ratio by the end of FY19 to 20?
On a long-term basis, we want our cost-income ratios to be certainly below 50%. Since we have made so much of investment in the last 2 years, it is taking us time to bring down the cost-income ratio. The cost is because the branches that we put takes about 18-22 months to break even, and takes about 36-40 months to reach a 50-55% cost-income ratio. By the time we reach the fourth quarter of 2019, we have taken a stretch target of saying that we need to be at 55% cost-income ratio, at least for the fourth quarter. And these will come because of the efficiency of the frontline sales team, introduction of frontline and customer-facing technology that can reduce the cost. So there are various measures being taken, and we are very clear that it is the upfront investment that we have done in branches which is what has caused the increase in cost-income ratio. And over a period of time, we certainly believe that we can bring it down.
Mr. Natarajan, we wish you the very best for the future. Thanks very much for joining us and giving us those details about your numbers.